All right, it's deja vu all over again in the commodities markets. Prices continue to soar across the board. The CRB Commodities Index hit its highest level since October 2008 today. It's up 11 straight weeks since Bernanke first hinted at a new round of quantitative easing, that back in August. That's his longest winning streak since Jimmy Carter was president. So is the commodity play bulletproof, or are they dangers lurking? Here now we have Harry Rady. He's at Rady Asset Management, and Dave Goldman, former head of global fixed income research at Bank of America, now senior editor at First Things Magazine. Dave Goldman, let me start with you. Is this a permanent boom, or is this a bubble that's going to burst with a veil of tears everywhere?
This is absolutely not a bubble. It's entirely rational, Larry. There are two stories here. One is the insurance policy story. Gold is an insurance policy against the likelihood that QE2 starts to look like Titanic 1. The Fed, in effect, is asking central banks around the world to absorb nearly $1 trillion a year of U.S. dollars. They don't like it. They're buying gold. And one of the reasons gold has not been as volatile as you'd expect is because central banks are buying on the dip. So I think gold as an insurance policy belongs in every portfolio. Of course, if the Federal Reserve comes to its senses and ends this destructive money printing binge, gold will in fact fall, but other assets will do better. The growth story is an Asian growth story. The Chinese demand for iron, manganese, copper, and so forth is bottomless.
Let me get Harry in here. I want you to react to what Dave Goldman is saying. And Harry, look, a lot of people are betting on the fact that interest rates are negative. Short-term interest rates set by the Fed are negative. They are poised to put $600 billion in. Other central banks look pretty loose. There's a lot of money sloshing around, and inflation is in the air. Harry, I think you don't buy it. Tell us why.
Well, you know, I'm a deep value contrarian long short investor. So I'm always looking for opportunity on both the long and the short side. And I think opportunity exists on both sides. I think it's important that we bifurcate the commodity complex into two separate categories. The first category would be one driven by speculation, fear, euphoria, and many other emotions, and I would put the precious metals, primarily gold, into that category. And then, on the other side, the agricultural complex and energy, which is really being driven by some very powerful, long-term secular trends where the rest of the world's standard of living, they're going to eat greater amounts of protein, et cetera, et cetera. So I think
you'd be long those, is that right? You would be long those on more fundamental supply and demand grounds rather than speculative liquidity.
Yeah, I mean, you know, we're a deep value investor, so everything's a function of price. But in general, we're going to be long the agricultural complex, and we're going to be short the more speculative. You know, I don't know how you calculate the discounted net present value of the future cash flows of gold. You know, as prices go up, technology is going to find better ways to produce more of it. So I think at some point, gold is headed for disaster.
All right, gold is headed for disaster, Dave Goldman.
Not necessarily. The only reason the central banks of the world are swallowing $1 trillion a year of U.S. dollars is because the U.S. is still the world's superpower. None of them trust each other. But you've got a president who's trying to shrink our strategic imprint, make us less important in the world, and central banks, including the Germans and Chinese, who are openly on the warpath against the Fed for exporting inflation. At some point, as Robert Zoellick, the president of the World Bank, indicated earlier this week, we may have to use gold as a reference point because the Fed may have crumbled the throne under King Dollar. I agree, of course, that there are secular trends with other commodities. You've heard me talk about Australian miners on this program many times before. I own a lot of them and continue to hold them.
But, Harry, is it possible, in your judgment, as you look at the gold story and the precious metal story, that the breakdown of the floating exchange system, it may be the United States that's breaking it down, will bring gold back toward the center of the world monetary system once again? And I would assume that would be very bullish for gold.
Yeah, I mean, look, it's impossible to predict what's going to happen in the short term. And, you know, and as we saw in the tech bubble of 2000, things can get more overvalued before they swing back to reality. So yeah, that certainly could occur. But as a long-term deep value investor, we're not going anywhere near gold.
What about some of these farm prices, Harry? I'm going to include copper, that's fiber, but sugar is up 60%, soybeans 25%, rice, oats, all that stuff. These are ag prices. What's your take on that? Would you buy them or sell them now?
You know, I think the opportunity exists on the short side for companies and sectors where they're going to have a difficult time passing on those increase in prices. A good example would be the restaurant stocks. Restaurant stocks are trading at historically high valuations. Many of them are trading at 52-week highs, and their margins are going to get squeezed. So we see a very exciting opportunity in the short side in restaurant stocks.
Dave Goldman, is there any sector that you would sell, despite your misgivings about Fed policy and so forth? Is there something you'd sell here?
No, I'm holding all the commodities across the board. I think that the problem with trying to look for the discounted cash flow of a commodity like gold is that we do live in a world where there is true uncertainty. You've got probability distributions which are inherently unknowable, and the reason to own gold is not as an investment the way you own oil, copper, or food commodities, but as an insurance policy. And again, it belongs in every portfolio. I would buy on dips, but I would not try to trade gold as a one-way speculative bet.
What about the CRB futures index itself, Dave Goldman?
The CRB Futures Index contains a large monetary component, and all the commodities will get crushed at such time that Bernanke is forced to do what Paul Volcker did in October 1980 and tighten interest rates because the world won't accept the money printing anymore.
And Harry,
that's the risk.
If you could help me out real lightning fast, your quick take on energy. You've got oil prices very high and natural gas prices kind of low. What's your quick take, Harry?
Well, from a BTU perspective, natural gas is trading as cheap as it ever has historically relative to oil. So our largest sector exposure by far is natural gas-focused E&P companies, and M&A is just starting to tick up, and we think this is the tip of the iceberg.
Wow.
We think M&A goes through the roof in the natural gas-focused E&P companies, so we backed up the truck.
All right, thank you very much, Harry Rady and David Goldman. Great commodities update. Up next on Kudlow, the stock rally hits a little bit of a roadblock, 2 down days. What's behind the pause? And will the reflation trade continue? And, oh, by the way, a look at the overseas markets trading right now. Check out Japan's Nikkei up over 1% already in their early